Hey everybody, it's Chris with Life 180, and this video is going to be a bit controversial. So I am going to do a deep dive into the New Heights Accumulator IUL, that is the main flagship product that World Financial Group is selling. And so let me give you a little backstory and then I'll get into it. So ultimately, here's what happened. I did some videos and obviously if you've been following my content, you know how I feel about Index Universal Life as a whole. And ultimately what's happened is, people have different opinions. If you haven't seen the video that I launched yesterday on Index Universal Life and how options are purchased and how IUL companies actually guarantee a 0% floor and give you upside potential, you need to watch that. I'm not gonna go into detail there, but I think when you watch that video and then you come back and you watch this video and you understand, it'll be really impactful. By the way, before I go any further, if you are an agent and you're watching this, I would really encourage you to subscribe to this channel because I'm creating a ton of content. I'm on a mission to educate people. I know a lot of people are selling Index Universal Life, and you're probably selling it for the reasons that you want to serve people, you want to help people. You're probably like I was at the beginning of my career, and you had bought into the idea that Index Universal Life is this great product that can serve a lot of people's needs, and the old concept of the rich man's Roth and an alternative to be able to get outside of qualified accounts, and you have that upside opportunity, that downside protection, all these things. But I'm here to tell you it's not what it's cracked up to be. And ultimately what I'm going to do is, I did a video a couple days ago on the 5 levers that life insurance companies use to make sure Index Universal Life policies will never perform the way that they're illustrated for you. And I would encourage you to go back and watch that as well. I'll link that above as well. You could see here, but I would really encourage you to think about this differently. If that is you, if you really truly want to serve people, I encourage you to think about these things. If you are a World Financial Group agent, if you are looking to purchase with World Financial Group or purchase a policy from a World Financial Group agent, this is going to probably be the policy that they're trying to sell you. And I encourage you to really think about this and really think about what I'm going to share with you. And that's it. So what I'm going to do is I'm going to get into this. I've got my computer up and I'm going to go through this, and I'm not going to go through every line by line because that would take way too long. But what I am going to do is get into some of the details here as to why this policy came about. This guy saw my videos, was telling me I didn't know what I was talking about. So he said, I'm going to build, I challenged him, I guess, to build an illustration for me. And he said he was going to build an illustration that was going to be amazing, was going to be way better than anything that I could produce with whole life insurance or anything of that nature. And, I'm not going to sit here and argue with him because the bottom line is you can make an IUL illustration look phenomenal. But I got to tell you, if I thought it would perform the way that they illustrated, I would be all over it. Believe me, I would buy that. I would buy it in a heartbeat. The bottom line is anybody who, doesn't realize these things don't perform the way that they look like they will, just hasn't been selling them long enough, hasn't been around the block to understand what's going on. So, I'm going to scroll through this slowly. If you want to read all this, you can. This will get you access to the illustration. You can kind of see all the disclaimers. I'm going to scroll down slowly until I get to the place that's actually relevant. It's got he included a 20-year no lapse guarantee period. So there's a rider you can choose to do a 20-year no lapse guarantee. I don't know if it's included automatically or if he added it to this one, but either way, key summaries and terms. So ultimately it goes through, these key summaries and terms. It explains kind of what they are: the fixed interest strategy and allocation option funded by Nationwide's general account and credited interest at rates periodically declared in advance. So if you choose for the fixed interest rate strategy for a loan, I think that's probably what you could do, guaranteed value. So it just talks about all these different things. It talks about all these core indexing strategies right here. I'm going to get into these in a little while. That's going to be a big part of this video. It's actually one of the big reasons I'm doing this video is because of those indexing strategies. Choice plus, okay, no, we don't need any of that. Don't need any of that. Okay, so So, okay, the benchmark index strategy is a 1-year capped S&P 500 strategy with a 100% participation rate, 0% floor, and a 10.25 cap. So this is saying, I think that this is what he was using for an example, saying the maximum it can be illustrated at is 7.89%, and the minimum you can illustrate it at is 3.93. So let's go from there. All right, here we go. This is going to be fun. So I might come back to this actually. I'm going to come right back to this. So page 6, I'll come right back. So one of the things I want to get to when you come into all this is I want to go into the policy numbers really quick. So, and then I'll go back to page 6 and talk about it because I think it's important to give some context. So if you come into here, let's look at the principles of this. So this is, oh, that's the guaranteed. I'm going to go to the non-guaranteed. Because they're always going to tell you the guaranteed doesn't matter, even though I will tell you it kind of does. I mean, it doesn't matter from the context. It'll never be as bad as a guaranteed, but the truth will always be somewhere between the guaranteed and the alternative rate. But like the alternate rate here is actually probably pretty okay. So you might be able to go on that long term, but you know that's for you to decide if that's a risk you want to take. The alternate rate, if you're ever going to buy one of these things, I would never go according to the non-guaranteed assumed rate over here in this column. I would always go according to the middle alternate rate strategy. And if you're comfortable with the results there, then you can be okay. You know, are you still taking risk on? Sure you are, because it's a non-guaranteed product. That's one of my biggest challenges with IULs is a lot of these agents are touting. I'm not saying the agent that gave me this illustration is touting it as a guaranteed product, but I hear people like Doug Andrew and people of that nature talk about how, and Curtis Ray talks about how the fact is, listen, these products are, you know, have all these guarantees associated with them, but the reality is there's no guarantee that your cash value is protected in these policies. And so if you look through here, year 1 here, I put in 20,000 hypothetically, right? And it's showing that my net surrender value is 9,800. So that means I lose 50%, over 50% liquidity. Year 2, it gets a little better. Year 3, better, better, better. It gets better all the way down. And you can see here, this is how you break this down. If you ever get one of these illustrations, it's important to look at the target premium. That's basically, the target premium is what they're getting paid their base commission off from. And so that's important to understand. So the guideline annual premium is, you know, anything between the guideline annual premium essentially and this, they're going to get paid a smaller commission on. Most companies, I don't know what they pay it at, what Nationwide pays for compensation at that level, but typically it's probably 4.5% on the overages. And, you know, depending on the agent you're working with and their success level, the more successful they are, the higher compensation they're getting. But at the end of the day, there's probably this contract, if I were to do it, would pay somewhere in the overall, I'm not saying the agent is making this, but this would pay somewhere in the 150% range of this number. So like, let's say that's $5,000 even. So this would pay probably $7,500 in commission to the agent who sold it, or not the agent, but in total commissions for upline commissions, agent commission splits, all these different things. That's about how much money is in the contract to be able to pay out in commissions for that product is about accurate. So you break it down. I put in, you know, 20,000 a year in this contract, and it looks like awesome. The net surrender value is 1,094,000. But here's the deal. Look at these numbers. He's doing the assumption on 6.32%. And that's what these assumed are. Now, the problem with illustrations is that, you know, we don't exist in a bubble. It's kind of like the average versus actual returns. It doesn't work that way. You're not just getting this nice linear compound growth of 6.32. It's never going to happen that way in real life. You're going to have 0 years, and when you have 0 years, you're going to have increased expenses, which are going to eat into it. So even if you have good years later, that is what it is. Now, you know, the biggest thing that I can tell you is that I did a video that you need to watch on how they pay. I think I mentioned this at the beginning on how they pay for options and how they do that 0% floor and upside opportunity. That also is going to show you why cap rates are going to go down. And so when cap rates go down, if for in fact you have these policies that you know, has this 6.32 assumption and $1.94 million, 1.094. Here's the bottom line with that. It's important to understand when I rail against these policies all the time, I'm not railing against the fact that, you know, I'm not railing for the fact that the policy is going to lapse or implode completely. What I'm saying is one of the dangerous components of these is expectation management. If I'm buying this policy at $20,000 a year, and I know for most people that would be a big commitment. So if I'm buying this policy at $20,000 a year to try to achieve this $1 million, my goal is income. And I'm gonna get to that in a second, but my goal is income. But here's the problem. $1 million, 1.1 million we'll call it, versus $654,000, which is what I think is the safer play, even though I would probably even, you know, tone it down just a little bit maybe. But the bottom line is it's a safer play, you know, than the 1.094. That 6.32% is never going to happen, because what they're going to do is they're going to reduce cap rates. And if you don't understand why, you don't believe me, I'm not going to get into that in this video. You have to go watch the last video. You know, I pinged it above, and I'll put it in the end screen at the end of this as well. I'll make sure you can reach it. But there's a couple things here that I want to touch base on is the loans rate, right? Like if we're gonna buy this policy, here's what I know to be true. You're buying it because you're looking for income, right? So here's one of the things, the way this illustration bugs me, that really drives me crazy. If you go here on page 9, it shows the loan rates, right? So it gives a declared loan rate, right? So there's two different types of loan rates. There are declared loan rates with Nationwide, and there's alternative loan rates. Now, a declared loan rate is basically a fixed loan rate. So what it says is policy year 1 through 10, the current loan rate is 3.9%, and the guarantee is 3.9%. So year 1 through 10, if you take loans and you choose the fixed bucket, they're going to charge you 3.9%. That's all fine and good. The loan portion on the accumulated value will be credited interest at the following rate. So if you take a loan against the policy year 1 through 10, you're going to be charged 3%, right? Or you're going to earn, I'm sorry, you're going to be credited 3%, but you're going to be charged 3.9%. So that's a negative arbitrage. So that will eat into the policy, that the cash value will eat into the policy at that point in time. So most people will not choose that loan rate. Most people are going to choose the alternative policy loans, right? They're just going to. They're going to choose alternative policy loans because that's more the variable option. And so what this is showing, this is where it drives me crazy, because this is what most people do. And when they illustrate for income, they bake it in. I don't know if this guy thought I wouldn't pick up on it or what the deal is, but if you plan on buying these, you need to have transparency into what you're doing. So the biggest issue that I have, and I have another illustration that I ran, and here's why. Because check it out. In this situation, I ran it for income, right? So if you look down below, check it out. If you run down below, I have it being run for income, right? You can see income right here, right? And in that, there's loans, and in the loans, you know, the loans accumulate throughout the years, and it is what it is. That's not the important part of that, but I'm just trying to show you that when you run it for income, what it does, look at this, it shows an illustrated rate of 5% and a maximum of 8. When you go to the one he made for me, the illustrated rate is not available. Now that key delineation, if you're looking to do this, is gonna give you a lot of transparency and a lot of clarity on what you need to do with your policy, or how you would make your decisions around your policy. Because here, let me show you something. When I scroll down here, there's gonna be a place where you have to sign off. This is unbelievable right here. This is insane to me. So page 16 of the illustration, you go down here and it shows you here, I have received a copy of this illustration and understand that any guaranteed elements illustrated are subject to change. Any non-guaranteed elements illustrated are subject to change and could be either higher or lower. The sales representatives told me that they are not guaranteed. I also understand that the illustration is not a contract and that the terms of the policy constitute the actual agreement of coverage, right? So I, the policy owner applicant, understand that I selected the premium shown in the illustration to show Nationwide how much premium I intend to pay, because interest credited on a non-guaranteed basis varies over time, is rarely the same year over year, and may be limited to the guaranteed minimum for extended periods of time. I understand that I may be required to pay additional premium to meet my goals and or prevent policy from lapsing, right? So all these things are in the disclosure, in the disclaimer, and the number one thing that agents say is, don't worry about that. So check this out. It comes into play when you're talking about the loan rate. Like, this is so important to understand, because here's the deal. You go illustration here at 5%, right? This illustration at 5%, that's what the loan rate is illustrated at. So I want to go down here really quickly. When it illustrates at 5%, the Index Universal Life illustration regulations require that the maximum assumed interest rate credited to the accumulated value in the alternative loan illustration is equal to the lesser of the illustrated rate or the loan interest charge, currently 5%. So it's saying we can illustrate this 5% plus 50 basis points, half a percentage point. So what it's saying is, when you start taking loans from the policy against the policy at age 65 for income, we're going to start showing you that the illustration is actually going to drop from 6.32%, that assumed rate, and it's going to go it's going to go down to that 5.5% rate. But it's still building in 50 basis points, half percent of positive arbitrage for the policy to be operating efficiently, right? And when you're 65 and the cost of insurance is going up, the bottom line is the amount you have at risk in an IUL is the net amount at risk, meaning that's how much you're paying insurance charges on. That's what your cost of insurance is based on, is the net amount at risk. So if you had $500,000 policy, $200,000 of cash value, that $300,000 spread is the net amount at risk. So if you start taking policy loans out and you have negative arbitrage, that starts creating more expense and more net amount at risk inside of the policy. That creates problems. You understand what I'm saying? It's not good. And so here's my big issue. That all looks good, but now let's go down to page 16 on this one. Notice this disclaimer is a little longer. When you run an illustration without the income included, they don't include all the disclaimers about income. But the bottom line is, nobody's ever gonna buy this without income. So anybody that runs an illustration without income as an agent is a shyster. That is just horrible. Either that or completely uneducated about all this. So let me zoom in here. So let's read the details on this one, because it's crazy. I've received a copy of this illustration and understand that any non-guaranteed elements illustrated are subject to change and could be either higher or lower. Okay, that's the same. The sales representative has told me that they are not guaranteed. I requested the illustration of one or more alternative loans and understand, this is where it's different, and understand that while an alternative loan has the potential to credit interest at a higher rate than the corresponding loan interest rate, there is also a significant risk that alternative loan interest credited will be substantially less. I'm going to read that again. There is a significant risk that alternative loan interest credited will be substantially less than the corresponding loan interest charge rate, which I understand significantly increases the risk that I may be required to pay additional premium or make loan repayments to meet my goals and or prevent the policy from lapsing. I understand that this illustration is not a contract and that the terms of the policy constitute the actual agreement and coverage. Did you hear that? I'm not going to read it again. Rewind, listen to it again. It is so important. So you got these people that are running these policies without showing this, and they're basically omitting and getting you to sign for something that you're not even looking to buy. They're not being completely transparent with you. And for me, like, the only reason people buy this coverage, the only reason that people from World Financial Group are selling this policy is for an alternative cash stream for income and retirement. And they're not even illustrating. This guy says he's a leader with the company and says he knows exactly how to build these policies, and this is the best policy in the world that could be, you know, for anybody else out there. And yet he omitted one of the most important things that people need to see, need to be understanding, need to have transparency in, and they can't even make an educated decision. If I was some bystander that had no idea what I was doing, I would have just looked at this and been like, wow, that $1.1 million looks amazing. That's fantastic. 6.32 sounds like really conservative, but you know, that he doesn't understand, and the prospective client doesn't understand that cap rates are going to come down. They're not guaranteed. They're not going to get there, and these loan rates are just another manipulation thing. Now, I want to get back up here to this part. I know I said I'd return here. So here's what I want to talk about. I did this. I'm not going to get into the whiteboard stuff. I did that yesterday on the video. Go watch it. I'll end screen it. You can see it. But here's the bottom line. Life insurance companies it's important to understand how they create the floor and the cap, the 0% floor and the upside potential. Here's what they do. They say, okay, we know every life insurance company, I'm gonna try to do this fast. Every life insurance company has a return that they know their general fund is going to get. Let's say it's 4%. Most companies right now are between 3.5% and 4.5%. So let's say it's 4%. So what happens is the life insurance company says, we know we're going to get 4%. So if you give us $10,000 of premium, and let's say that $10,000 is going into the cash value, it's going to be more premium than that. But let's just, for simplicity's sake, say there's $10,000 in cash value going into this policy. Actually, here, I'll use this policy as a whole. So like I'll just go down here to the cash, and let's say right now it goes to not accumulated values, so $17,474. So in this policy, what they would do is they would say, listen, I know you have $17,474, right? That's how much in cash you have. So what they would say is they would go and they would say, I'm going to get my calculator out here. The insurance company would say you have $17,474, and they would say we know we're going to get a 4% return. So that's $698. Let's call it $700. We're gonna use that guaranteed money that we know our account is gonna do, because when you deposit that $17,474 with our company, we know we're gonna generate a 4% return. So by the nature of you giving us that, we're gonna take the profit that we know we're gonna generate with the money you're giving us, and we're gonna invest it in call options. That's it. All you're doing is day trading, basically. Like they're buying call options with it, and they give you the 0% floor because they just took the profit that they know they're going to generate with my money that I gave them, and they're going to buy call options with it. Now, here's the problem. Back in the day, this is why cap rates are going down, because back in the day, in 2010, it was before Nationwide even was in the IUL game and was even selling IULs, that call options were they were a lot cheaper, you know, for the S&P 500 and the Dow Jones and the Russell 2000, and interest rates were higher. So they had more money to buy call options because the general accounts were achieving like a 7% return, not a 4%. So it was able to buy you almost twice as many call options. And then call options were cheaper. So once again, that allowed you to buy more call options because you had more money to buy a cheaper product. Obviously, that works out for people back then. Since that time, interest rates have gone down. That puts pressure on cap rates, and the cost of options has gone up. But here's how life insurance companies have gotten really creative. And this is where it really ticks me off. And you get these people going out there, like this guy who's telling me that this product is awesome. And he's saying, listen, I have people that have earned 61% in my IUL, and that's fantastic. Like, how can you say these are bad? Well, because yes, you can get 61% on a given year. And I don't care if you have a illustration that shows me that can happen, because I'm not a fool. I know that can happen. I look at this and I say, okay, well, why did they do this? Look at these. Everybody's heard of the S&P, right? Everybody's heard of the capped S&P 500, the 2-year S&P 500. Everybody knows what these are. And look, the cap rates on here, the illustrated rates are lower. You notice that? Why is that? And you look at the 30-year historical average, you know, they are what they are, and the illustrated rates are lower than the rest of these. Now, here's the bottom line. When you look at these numbers and you look at these accounts, it's important to do some digging. Has anybody here heard of the JP Morgan Mosaic 2 Index? Has anybody heard of the 1-year New York Stock Exchange Zebra Edge Anybody? Bueller? Bueller? I haven't heard of it. I've been in this industry a while. This is kind of my thing. It's kind of what I do. Okay, well, so I did some research and I looked these things up. And it's not a coincidence you haven't heard of these because this JP Morgan one was created back not until 2016. And hold on here. Here's the problem with this. Look at this. They go 30-year historical average. How can they even... There's nowhere on here. Look at this. There's nowhere on here that says, oh, by the way, this index isn't even 30 years old. So talk about the lack of transparency just gets bigger and bigger, wider and wider. It makes my head want to explode. Like the lies, the deceit is just insane to me. So 30-year historical average hasn't even been 30 years. This 2-year JP Morgan Mosaic 2 and the 1-year Mosaic 2, check this out. I'm gonna go here. This is, oh, look at this. JP Morgan Mosaic 2 Index right there, April 2021. Check this out. So I'm gonna go here. I'm gonna try to zoom in actually here. Let me see if I can do this. Let's do this here. I actually read the small print. This is fantastic, isn't it? Let me go here. So, all right, hypothetical back-tested performance. Hypothetical back-tested performance of each basket constituent from February 7th, 2012 through December 27th, 2016, labeled back-tested and chart above, and actual performance, because this is when this was created, of December 28th, 2016 through March 31st, 2021, labeled in the chart above, okay? So here it's showing this is a new thing. And so this index as a whole, the Mosaic 2, this index as a whole is literally, I can't confirm this, but my guess is this index was created for Nationwide. That's my guess. I couldn't find actual words or whatever that confirm that, but that's my guess. That's what happens a lot. These insurance companies are creating indexes and partnering with these companies. What they were doing for a little while is just kind of creating their own little fictitious indexes, but some of the companies were getting into trouble. And so then the powers that be, the regulation people basically, you know, put an axe to that one, and they said, no, you have to do real indexes. So then they partnered with people like JP Morgan, you know, and the New York Stock Exchange, and they created things like the Mosaic 2 and the Zebra Edge. Now the Zebra Edge, this gets even funner. I'm on, so like the Zebra Edge here, you can see here now, it's won awards. Oh, this looks awesome, right? The New York Stock Exchange Zebra Edge Index looks amazing. It's you know, it's this index. It looks like it's this fantastic award-winning thing. God only knows what this award came from. The Structured Retail Products Americas Award in 2017. My guess is that's an award that you know, Nationwide created or something of that nature. It's kind of like, you know, I don't know, like saying you're a bestseller because you sold your mom a copy of your book kind of thing. It has no merit. But check this out. It won the award in 2017 for Propriety Index of the Year Americas. The index was developed with Roger Ibsen of Zebra Capital and is exclusively available with the Nationwide New Heights Fixed Indexed Annuity, partnering with UBS and Nexus. So UBS and Nexus helped put the index together, and it's available through the Nationwide New Heights Fixed Indexed Annuities. And guess what? That they tap into the IUL because you know, they can do that. They run the show. It's Nationwide's product. They can kind of do what they want. And here's why. Do you know why these companies are doing this? First of all, once again, it says it's back tested to a 30-year historical average. These things haven't even been around that long. The Mosaic 2 index has been around less than 5 years, and they're saying a 30-year historical average, and they don't have anywhere on here that says it's hypothetical. Right? There should be a big old asterisk next to that 10.52, because when you say 10.52 over a 30-year period, it makes this 6.32 look like it's predictable, look like it's conservative, and it's far from that. The reality is, the reason that they're doing this is because The facts are that these S&P 500 call options have gotten a lot more expensive over the past decade. There's so many more players in the market. Insurance companies were buying so many call options because all these indexing companies were getting more and more into there. And if you know anything about how call options work, the more people that are buying them, the more companies that are buying them, the more expensive they get. And when that happens, it forces the cost of cap rates to go down. And so now what happens? Interest rates go down, option prices go up, cap rates really come down even faster than interest rates. It has to be that way. And so what do? They say, well, we can't afford those options anymore and be competitive, so let's just create our own index and have fun and just trick people. That sounds awesome, doesn't it? And so, like, here's the bottom line. When you combine the lack of transparency in the loans, the lack of transparency with the indexing and how they work, and when you break down the fact that, you know, they're running this at 6.32% and they're not illustrating the income that I want to take out of it, and the facts are it's not going to perform. I mean, I can't say the facts, but 99% sure it's not going to perform at this, you know, $1.1 million level. It'll probably be a little less than the 654,000, but I put 500,000 in to only get 654,000 and still have that be at risk. I'm sorry, but when you compare apples to apples, I think I'm going to look for another product. And while I don't think this policy would lapse, I do think there are infinitely more effective places that I could invest my money, that I could save my money. I'm a big believer in whole life insurance because it is not an investment. It's a savings alternative because it has the same guarantees that savings accounts have. You should never try to get your rate of return and use your life insurance policy as an investment. It is a savings vehicle, and when you look at it like that, you have to have the same attributes as savings accounts have: liquidity, use, control, guarantees, and get a rate of return that beats what your bank account is going to do. That's what a whole life policy does. And when you look at the fact that it also has living benefits in a whole life policy, the same living benefit structures that IULs have, it's a no-brainer. So if you are selling these and you want to learn more, reach out to me. I'm going to put a link below for any World Financial Group agent that is like looking at this and being like, holy crap, like I didn't realize all this. I'm really, I was trying to play nice. People just kept coming at me and, you know, trying to act like I didn't know what I was talking about because these caps and these uncapped rates and look at these indexes. But like, I'm sorry, your lack of transparency and the lack of integrity around that, I'm not calling out the people who didn't know about this because listen, I was new at one point in time too. I sold IULs for 3.5, 4 years, and I believed in them a while. I drank the Kool-Aid too. But when I learned what I learned, I woke up and I had to get away from that, and I had to get over to actually helping people in a way that I knew I would not hurt them. And this is a way that if you sell them this, you may not lapse their policy, but if they expect $1.1 million and they only have $654,000, I promise you hurt them. It's an expectation management thing. So anyway, if you have any questions, and I'm sure you will, go ahead and leave them in the section below, and I will try to engage with every single one. If you found this video valuable, please hit that like button, hit the subscribe button, click the bell. That way you get notified every time I launch a new video. I'm going to be doing a lot of specific product assessments with every different company out there because I think it's important to go down through, and quite frankly, I'm just curious and interested to see what kind of garbage is going on out there in the industry, and I'm going to do assessments of all these things and see what's going on. So if you want to see those, if you want to be made aware, if you want to learn more about IULs and whole life insurance and how to build your business online, that is what I do. I'd be happy to help you. Reach out anytime. I'm passionate about this. I'm on a mission to be able to help agents be successful and help their clients be successful with their personal finances. So I hope that helps. I hope you have a blessed, inspirational day, and we'll talk soon.